WeWork's rise and fall. The $47 billion office space disruptor. Office-sharing company WeWork filed for Chapter 11 bankruptcy protection. The company, which was valued at $47 billion back in 2019, tried and failed to go public 5 years ago. We're looking at WeWork here. This is something that had been anticipated. They filed for bankruptcy protection, Chapter 11 bankruptcy protection, in New Jersey. It was once the world's most valuable startup. WeWork sold itself as, and from the outside looked every bit like, the future. But a confluence of excess internal mismanagement and external headwinds have now resulted in a spectacular fall. What was once the US's most valuable startup just filed for bankruptcy. Founded in 2010 by Israeli businessman Adam Neumann and his American counterpart Miguel McKelvey, WeWork aimed to revolutionize the traditional concept of office spaces. However, its extraordinary rise was followed by a quick fall, marked by a harsh operating environment and a failed IPO attempt that unveiled a series of managerial failures and the startup's financial turmoil. Let's dive deeper into WeWork's captivating journey, exploring its business model, explosive growth, the catastrophic IPO attempt, and the subsequent challenges that led to its filing for bankruptcy on the 6th of November, 2023. WeWork was a space-as-a-service business. It offered a simplified membership model that delivered a premium experience in place of the complexity of leasing real estate. Its business model rested on renting space from developers on a long-term basis, renovating and parceling the property, and subsequently leasing it out to short-term clients. WeWork's revenue stream primarily came from memberships and services. Through its different membership plans, WeWork All Access and WeWork Workplace Management Solution, the company provided access to booking workspaces, conference rooms, and private offices, all from the members' mobile phones. The memberships did not include service fees, such as access to conference rooms, printing, photocopies, setup fees, phone and IT services, parking, and others, which made up the second biggest stream of income for WeWork. The company differentiated itself through the many perks it offered at its locations around the world. It provided glamorous offices with open space and modern design, unlimited coffee, free beers and snacks, lounges and phone booths combined with outdoor terraces, cafe areas, exercise rooms, swimming pools, valet parking, mini golf, and others at specific locations. WeWork believed these perks reinforced an employee-first culture and increased engagement and productivity. WeWork started in 2010 with a single location in Lower Manhattan, New York. The idea was inspired by the high level of empty office spaces following the 2008 financial crisis and the number of freelancers and startup founders that crisis created. It was a novel and welcomed idea that you could rent a desk for as long or as little as you needed and mingle with other freelance workers or startup founders. By the following year, the company had created WeWork Labs, created especially for these young businesses. It gave them not only desk space and meeting rooms to operate from, but promised support for their infant days. The labs, they said, would nurture new companies and help them grow. By 2014, WeWork had 51 locations in the US, Europe, and Israel, and the brand announced plans to expand to every continent on the globe by 2017. In 2016, it was worth a staggering $10 billion and was dubbed one of the most innovative companies in the world. In 2017, SoftBank Vision Fund's $4.4 billion investment valued the company at $20 billion. At the time, SoftBank's CEO saw major potential in the company, including its innovative analytics about the use of the workspace that offered optimal utilization of the offices. In the next 2 years, SoftBank made subsequent investments, including the purchase of a warrant to buy up to $3 billion worth of shares in the company. At the beginning of 2019, WeWork raised an additional $2 billion from SoftBank, which brought the total funding by the bank to over $10 billion. These investments fueled its rapid expansion, including the purchase and rental of new locations, expansion to new countries, and capturing a larger customer base. WeWork was worth more than giants that had been in the industry for decades, like IWG, and its valuation exceeded that of any other co-working space-oriented firm. To put things into perspective, IWG has 5 times as many members as WeWork, operates in 4 times as many countries, and generated more revenue, all the while having a lower valuation than WeWork at its peak of $47 billion. Despite years of consecutive undisclosed losses in terms of net income, WeWork appeared to thrive in its industry. The filing of the IPO, which was made public on August 14, 2019, left everybody in shock. First, it unveiled WeWork's business structure, the so-called UPC structure, which offered tax benefits to Neumann and other insiders who paid taxes on any profits at individual income tax rates, while public shareholders faced double taxation since the holding company paid taxes on its income and then on any dividend distributions. That structure also created different share classes, which would give 20 times as many votes per share to Neumann as to ordinary shareholders. Seeing this, investors began worrying about the unrestricted control of the founder. Secondly, the filing revealed how WeWork had paid Neumann rent on buildings he personally owned and bought the trademark to the word "we" from him for $5.9 million. In other words, the founder was enriching himself at the expense of the company. Thirdly, investors found the company's financials even more concerning and realized that the company would not be able to produce real profits with its current business strategy. It revealed increased expenses, operating losses, and an over-leveraged balance sheet, painting a bleak picture of WeWork's ability to turn a profit. This revelation prompted skepticism among investors, eventually leading to the withdrawal of the IPO. The COVID-19 crisis dealt another blow to the then ailing company. The lockdowns and ban on working in offices reduced demand for office spaces. WeWork's dependence on short-term leases proved problematic as it created income inconsistency. The company also had signed most of its leases with landlords before the pandemic, when the rents were at their highest. However, after the pandemic, people expected to pay less for office rent since there was lower demand. This created a gap between the expected income and lease obligations, resulting in WeWork incurring losses. In an attempt to save the company, WeWork agreed to a $9 billion special purpose acquisition company merger with BOX Acquisition. As part of the deal, SoftBank retained a majority stake in the company, but agreed to a 1-year lockup on their shares. WeWork's losses continued to deepen even as it made preparations for the merger with BOX. In the first quarter of 2021, WeWork lost $2.1 billion, which included a $500 million non-cash settlement with Neumann. However, the deal was finalized on October 20th, when the shareholders of BOX Acquisition voted in favor of its transaction with WeWork, enabling WeWork to trade on the New York Stock Exchange under the ticker WE on October 21st. The company finally went public, with shares rising 133% by the end of the day to 13.8, implying a valuation of $9 billion, 5 times less than its initial valuation in 2019. The rapid expansion of WeWork proved to be unsustainable. It aggressively expanded globally, signing long-term leases on expensive properties without properly assessing the demand, which led to a significant mismatch between income and expenditure, creating a huge financial burden. To finance the rapid expansion, WeWork relied heavily on investor funding, pushing its valuation much higher. At its peak, WeWork was valued at a staggering $47 billion despite never turning a profit. This inflated valuation was based on optimistic assumptions about market size and growth potential, which ultimately proved unrealistic. The failure to achieve profitability left the company vulnerable to market fluctuations and unable to support its debt. Adam Neumann's chaotic approach to management was a problem. He was known for his eccentric behavior and questionable decisions. The S-1 filing before the attempt to go public in 2019 revealed some of Neumann's unjustified huge investments, such as opening an elementary school, We Grow, in New York, investing in an indoor wave pool company and buying a private jet for $60 million. Moreover, he collected rent from WeWork on properties that he owned himself and sold the trademark for the word "we" to WeWork for $5.9 million. This showed how the executives tried to enrich themselves at the expense of the shareholders. All these happened with the knowledge of the board of directors. They failed to properly oversee Neumann and address governance issues. The pandemic's shift to remote work significantly reduced demand for office space, further impacting WeWork's already precarious financial situation. Also, increased competition and changing preferences towards smaller, more flexible workspaces added pressure to WeWork's model. To sum up, rapid expansion, management failure, an inflexible cost structure, COVID restrictions, and a post-pandemic high-interest rate environment were the major factors at play in the downfall of WeWork. While WeWork has undergone significant restructuring and leadership changes, it remains to be seen if the company can fully recover and achieve long-term success. WeWork's case study offers valuable lessons for businesses of all sizes across industries. To build a sustainable company, we need to prioritize demand assessment over aggressive expansion, ensure your growth aligns with your resources and market realities, and prioritize generating positive cash flow over relying solely on external funding before achieving sustainable profitability. We need to manage debt cautiously. Finally, leaders should demonstrate ethical conduct and prioritize long-term success over personal gains. That's all from me today, guys. Like, share, and subscribe. Until next time, bye-bye, thanks for watching.